Yeah, thanks, Greg. Just wanted to provide a little more detail around the couple of slides that Greg sort of took us through. Uh, it's important to understand that, Auditrol positions itself as managing the technology and process orchestration and intelligence around risk controls. But, financial institutions in particular, as highly regulated institutions, have been managing risk and controls for a very long time uh, with more or less success. And the question is, how can we be more successful at it? So it all starts with the business model of the bank or the financial institution itself. And within the corporate governance structure of any financial institution, there is a board that plays an oversight role. And within the board, there is a specialized committee, a risk committee. And the risk committee of the board, in conjunction with the management of the financial institution, essentially uh, essentially sort of considers how to sort of manage the risk appetite for the bank. What capital reserves, what kind of customers they want to target, how they manage their internal processes, and so on and so forth. And they therefore sort of look at their foundational operational risk on the basis of a control framework and policies and procedures. And these operational risks can be managed at various levels. At a level of data, you have to define, what are the data elements that measure the risks that you want to control. And they can be critical data elements. You have to then identify business stewards, data stewards, and so on and so forth. So you do all of that. You build your processes out to measure, how you're sort of managing your risk through a business control function. You have various kinds of analytics and other generative AI models that now help with the orchestration of these processes. You have to worry about data security, privacy, cybersecurity, and you also have to manage your supply chain. There are a bunch of third-party vendors. So no organization is an island. They manage a number of people in the ecosystem, and you have to consider everything from SOX controls to the nature of those organizations and their own risk posture and data privacy postures as it relates to your customers. So with that sort of operational risk framework, you drive decisions around various kinds of risk. So there's market risk, there's always volatility in the market. There's liquidity and capital kinds of issues that any financial institution faces, having to do with assets and liabilities and risk weightage of different assets, as well as the availability of capital at various interest rates. So there's interest rate risk and other kinds of things. There's also credit risk. I mean, for a lot, particularly on the consumer side, but also on the investment banking side, there's credit risk in terms of the risk of lending to people, whether it's collateralized or not. And you have to sort of consider the volatility or the fluctuation of that risk over the credit cycle. And then obviously privacy and accountability. So you are at the end of the day accountable to your customers, to your shareholders, to the community that you participate in. There's a lot of ESG risk and other kinds of risks which are emerging as well. So that's the position in terms of the internal posture of the bank that derives from its business model and builds a risk appetite framework and measurement for controls around that framework.